In this video, we are going to talk about top 5 best dividend stocks to buy now for 2022. So before starting, please like this video and subscribe to this channel for our future updates. Dividend stocks that are carefully chosen can provide a formidable combination of growth and income to your investing portfolio. The idea is to invest in companies that are well positioned to navigate the challenging market environment that they will likely confront in the future years. As a guide to identifying such companies, we've selected 5 companies that are positioned to lead their respective industries and deliver substantial returns for their shareholders in the year ahead. Here are the top 5 best dividend stocks to buy now for 2022. So let's start. Number 5. Apple. Consider Apple if you want to add a strong growth component to your portfolio. Despite the fact that the digital behemoth is currently valued at a whopping $2.7 trillion, investors are likely underestimating its enormous earnings potential. Rising demand for 5G connection should help Apple's most significant product, the iPhone, maintain a steady upgrade cycle. Meanwhile, Apple's new M1 CPUs are boosting sales of its Macs and iPads due to their superior performance. Strong device sales, in turn, are propelling Apple's high-margin services to new heights. According to Wall Street projections, these factors will help Apple treble its earnings per share over the next half-decade. During this time, the company should be able to increase its cash distribution to investors. Although the present dividend yield is only 0.5%, a combination of share price increase and rising dividend income could result in substantial overall returns. Number 4. Waste Management. Look no further than Waste Management if you're seeking for a stock that will help you sleep soundly at night. The aptly titled Garbage Collection and Recycling Services Company has increased its per-share dividend for 19 years in a row, a streak that looks set to continue for a long time. In a figurative sense, Waste Management's virtually statewide network of landfills and collection sites forms a vast moat around its firm. Strenuous regulation and fierce homeowner opposition make it difficult for would-be competitors to gain market dominance. As a result, Waste Management is able to boost prices without negatively impacting sales. As a result, it generates an increasing stream of earnings, which it distributes to shareholders in the form of a continually expanding cash distribution. There will always be waste as long as there are people. As a result, investors can rely on Waste Management to provide consistent dividend payments year after year. The current yield on its shares is 1.5%. Number 3. Walmart. Consumers are likely to change their spending patterns when inflation raises its ugly head again and again. A significant increase in the pricing of products and services will prompt consumers to look for ways to reduce their expenditures. Walmart is well positioned to capitalize on this opportunity. The retailing behemoth is well known for its low prices on a daily basis. When customers are looking for methods to save money, Walmart anticipates an increase in traffic, both in store and online, as a result of this trend. Besides that, Walmart's huge distribution network enables it to negotiate the recent pandemic-induced obstacles to retail supply chains more successfully than its smaller competitors do. Growing numbers of clients shopping at its well-stocked stores should result in steadily increasing profitability, and, consequently, steadily increasing dividends. Meanwhile, investors might take advantage of the company's yield of 1.6%. Number 2. Ford Motor Company. Ford Motor Company has been around for 118 years, yet it is far from a stodgy automaker. CEO Jim Farley has put electric vehicles at the center of the company's growth strategy since taking over in October 2020. Battery-powered versions of Ford's iconic F-150 pickup truck and Mustang sports car are in high demand. To meet this rising demand, the manufacturer is scaling up manufacturing of electric vehicles, and sales of these higher-margin vehicles could help raise profitability. Ford's future is bright and robust enough that management felt comfortable restarting its dividend after a brief break during the pandemic's early phases. Its stock presently yields a respectable 1.9%, and investors should expect the automaker's dividend to rise in tandem with its earnings over time. Number 1. Bank of America. To battle inflation, the Federal Reserve has announced its willingness to hike interest rates in 2022. This has resulted in a significant sell-off in many high-priced growth stocks, but it could be beneficial to banks. As interest rates rise, the disparity between the cost of the interest they pay depositors and the interest they make on the loans they issue expands, resulting in higher profits for banks. Bank of America is in a unique position to benefit from higher interest rates. If interest rates rise by a single percentage point, the financial services behemoth will receive an extra $6.5 billion in net interest revenue over the next year. Higher profits should result in higher dividends, and Bank of America's stock currently yields 1.9%. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.